Welcome, welcome. So, a loyal viewer of the channel recently sent me this screenshot, which is on the screen right now, where they're doing stock trading and they've been able to unfortunately accumulate a loss so far, unrealized loss of $22,000. And in this video, I felt it was really important to go through and analyze exactly after speaking to them. I got a chance to speak to them, and they were nice enough to share sort of the ins of their brokerage account to let me deep dive into what caused this, how they were able to accumulate these massive losses, which I wanted to share with everyone today. So then that way, you can also ensure that you do not get to a situation where you're down any large amount, because this amount in the U.S. dollar side is quite large, and I think this is going to be very, very valuable for you to learn sort of what I've been able to discover. So let's jump in and find out a little bit more about what's going on. Number one, zero research. A lot of their purchases were made without even knowing what company they were buying. So they're doing a little bit of trading, a little bit of investing, but at the same time, they're just buying based off of gut emotion. And at the end of the day, if you're not doing any research into what you're buying, you're going to find yourself in trouble, because sure, good markets, maybe an uptrend, that will save you. But as soon as the markets start turning negative or going the opposite direction on you, then you're in big trouble. And what the first thing that they were able to tell me was that they were just seeing a chart, and without even knowing the name of the company or what they were even buying, they just felt, hey, I just want to ride on this momentum, which is okay to do. The trend is your friend at the end of the day in the markets when you're trading, especially in the short term. You can definitely catch a trend before it turns the other way on you. So as you can see by this chart here, they ended up buying this company, and there was a pop. We can clearly see a pop on the screen, and we had a good fair 6 months plus of it. And you had that little spike in the beginning of 2021. But then, as you can see, we're going all the way from 40 down to currently around $3. So at the end of the day, if you don't know why you bought something in the first place, how do you know at which point to get out? Sure, you could have gotten in, and as you can see in the July spikes, and then in the third quarter, fourth quarter of 2020, there were some nice spikes. And then obviously beginning of 2021, you had that massive one to get above the $40 range. But then the legs fell out and it just tumbled. And you can see this consistent downtrend for the last year, and it hasn't been able to recover. So the rule number one, do your research, know what you're buying and why you're buying it, because that will give you an indication of when to get out. You should know with any trade in crypto and stocks, before you enter the trade, you should know your exit, because you need to know what your profit margins are, not only in terms of a dollar amount, but in terms of percentage wise, because you need to be able to know what your drawdown on your account is in order to maintain a positive balance. Because with trading, I'm not talking so much about investing right now, but if you're going to be doing day trading or swing trading in the shorter term, the last thing that you can do is draw down your account. And the number one rule is don't lose money and never run out of money, because the second you run out of money, you're not able to get back in when there's a drop, to get in at cheaper prices. It will cost you in the long term. Continuing on, if we look at the fundamentals of this company, very poor, in a loss, not making any money, little to no revenue whatsoever. So again, it's at the end of the day, they were just buying because they saw an initial spike, but could not justify sort of why they bought it or why they're even holding on. And now they're holding on to losses way past the expiry date of when they should have gotten out. Oh, hey, it's Ubi. And as you know, it's the YouTube algorithm. And the YouTube algorithm loves when you subscribe to the channel, because not only do you help to support the channel. And I really appreciate your support to help grow the Smarter Personal Finance channel. But it also helps the YouTube algorithm to help promote it to other individuals that want to make their money work for them. So we would really appreciate a subscribe to all the new viewers that are currently watching. So another reason that I discovered that they were losing and continually losing, and one crazy thing is that these losses were also accumulating in a up market. Even when the market was doing very well, end of the year, they were still in just under 20. They were in the 16 to 18 range, and they just couldn't get out of it. And there's something I want to talk about that I use to kind of gauge whether there's any sort of incentive to buy a company, whether it's a short-term trade or a longer-term investment opportunity. It's talking about the tailwind, and something that you want to really look at is, as you know, a tailwind with an airplane, it helps it get to its destination faster, use less effort, less fuel, because it's got that push behind it. With a lot of these companies, why are they getting pushed up? Is it just because there's a general FOMO going on and it's just being pushed up? Or is there really something down to the fundamentals that's going to give it that extra push even when that sort of FOMO dies down? And that's the tailwind that you want to look at. A good example is Apple. It's a long established company, very profitable, and there's really no they're going to constantly make profits for their investors and for their shareholders. And there's always a tailwind where there's new product launches, whether it's the new iMacs coming out or the new MacBook Pros or the new iPhone 14 coming out later this year. So there's always something to help it push forward. But after, as you can see with the chart, after there's that initial spike, this is another company. After that initial spike, what's holding it up? Look at this one from October all the way down to where we are right now, $50 to 2022, end of 20, currently where we are sitting right now, $4. A massive loss. And you're just sinking. There's no tailwind here. There's nothing to keep the stock price elevated. There's nothing to keep investors interested. And that's the key. What is it going to take that's going to keep investors interested? And just to go back a few slide here, when I talk about the 45-degree angle versus parabolic, okay? So one of the most dangerous chart formations is the parabolic shape. As you can see in the July and October period here, where we're just going, just elevated, just parabolic, going straight up. This is pure FOMO, and this is one of the most dangerous places to be because you don't know where the top is. You know, sure, in the July chart that you can see here, if we zoom in a little bit, you can see that there was that spike. Yeah, we had a little bit of a drop and then that spike afterwards. But what if you bought at the top at the 50 and you were expecting a little bit of a drop, a little bit of a correction, and then, it would go to 60, 70, you were hoping, but that never came. And it probably may never come. So you're still holding on from these levels and you're going to be stuck there. That's the danger with parabolic. So what I teach is the most beautiful stock chart shape that you want to look for is a 45-degree angle. You're going to see a lot of industrials, a lot of value companies, value stocks that exhibit this shape. And this is a beautiful, slow, and steady. I just did the live stream yesterday on the crypto scams. Hopefully you got a chance to watch it. And I was talking about, you don't want this pump and dump type of situation. You want to get yourself to buy these stable companies. I talked about how there's no such thing as get rich quick. It's about the slow, the steady, and stay the course. And this is what the 45-degree angle shows you. You can see in a year, in a 2-year period, You had the pandemic drop in the beginning of 2021, but you had the tailwind. You had a beautiful shape, constant 45-degree angle. This company's making money. It's profitable. It's been around for ages. This is what you want to see. Here's another example as well. Nice, clean shape. You don't have the super spikes up and down. That's going to get you, from an investment point of view, look for something like this. This is going to keep you being able to sleep at night, where you're not going to be worried about even if the market crashes, companies like this, they don't really go down that much, thankfully. And because they're well-established companies, the institutional investors and retail investors are buying based off of proof of concept for being around for a while and actually being legitimate companies that are going to stay the course and be around for a while. So look for shapes like this, because this is going to be able to help you grow your portfolio from the long term, especially from an investment long point of view, from a 5-10 year. If you're trading, day trading, 1 or 2 days, sure, volatility. We all know volatility is crucial to getting in and out quickly. 15-minute trade, whatnot. Yes, you want volatility. But if you're looking for a more longer term investment, this is something that you really want to look at, being able to see these type of stock charts. Continuing on, the third thing that I wanted to bring up when I was looking at this individual's account was that they were spread out too thin. They had over 60 stocks that they were holding. And the problem is, a lot of the equity that they were holding was just a few shares. So, not a problem, but here's where the issue was. They're spread out so much, and they had a fairly small account when they were starting out. So, a recommendation is, sure, diversity is great. Absolutely. You need that, especially between sectors or asset classes. But when you're dealing with a small account, in order to see gains a little bit more quickly, you want to kind of have a smaller portfolio of number of stocks, for example. So instead of 60 or 70, maybe 10 would have worked out a lot better for this, because then you would have, the individual would have seen more gains from, instead of 1 or 2 shares, they could have had a basket of 10, 20 shares per stock. And the other thing that turned out to be an issue here as well is what happens to a lot of traders. Why a lot of traders are losing traders. We've all seen the 90% of traders lose money. And one big thing is, what I teach is, your emotions play a factor into how you trade. Humans are not good traders. We're not designed to be good traders, because our emotions go against our what we should be doing, and our natural sort of intrinsic intuition is preventing us from making money. So what happens is, there's one emotion that is experienced whether a stock goes up or down. So in a down situation, it's very easy to identify this. Stock goes down, and then you're holding on because you're hoping and praying that it reverses. But then it gets to a point where you're feeling so much pain, you just have to let it go. So depending on when your pain threshold is, that's when you're going to let go of the equity. So you're feeling pain on the way down, but you have these big losses because you're holding on to things way too long. In trading, the secret is to cut your losses immediately. You do not want to hold on to a losing trade, especially if you're trading now, I'm saying. From an investment long-term point of view, nobody knows the short-term cycles or the short-term movements. Yes, we could have news coming out that can, drop a stock very quickly, but it can also rise again. That's natural. We're going to see that up and down very quickly. But over the long term, the stock market definitely has a upward sort of bias towards it. But from a trading point of view, if you're trading, especially on the short term, you want to cut your losses immediately. So the problem with this one is holding on to losses that get bigger and bigger. So then you get pain on the other side when you gain. When this individual was having a winning trade, they were selling very quickly. Profits were only a few bucks. Now, no problem. If you have a small account, a few dollar increase in your account size from a percentage point of view, yeah, sure, that could come up to 5-10%. But the issue is not the small gains. It's the big losses that just completely destroy everything that you've worked for. So what happens as humans, we get this pain of loss on the gain side. So we see a little bit of profit, maybe $5, $10, $100, and we're like, I gotta sell because I don't want to lose that. So you're avoiding pain even on the upside. So that's also very interesting as well. And another point, and then the final point that I wanted to talk about was the absolute massive destruction that caused this account to get as big in the loss category that it did. And that is using margin. Now, brokerages, they're like banks. They want to make money. So lending out money to you at a very cheap interest rate, maybe depending on the brokerage, 2%, 4%, they will lend out that money so you can start making some gains if the market goes up. But the problem with markets is, and one of the rules of the nature of markets in general, is that they're random, they're unpredictable. Nobody knows when it's going to turn. Nobody knows when it's going to go up, when it's going to turn around to go down. So by not even knowing which way the market is going, even using that margin when you are perhaps in an uptrend, you don't know, are you on the tail end of it? Could it turn? It will magnify your gains, but the problem is it's going to really magnify your losses. I saw this graph. So let me read this here as an example. You have $20,000 worth of securities bought using $10,000 borrowed and $10,000 in cash. When the value of the securities drops by 25% to $15,000, since the amount you borrowed from your broker stays at $10,000, your equity becomes $5,000. That means your equity drops from $10,000 to $5,000, which is a 50% loss. If we look here, when the price drops by 25%, the equity itself is actually dropping by 50%. Your losses get really magnified. And that's a major problem because, yeah, you can use margin and they really make it easy for you to use margin. Usually when you sign up for a brokerage account, right away you're going to get a margin account, not a cash account. Some accounts you have to maybe ask for it, but which you can sign up directly for a cash account. But using your own money, you have $1,000 to trade. That's it. You can't get any more. You can't use that leverage. That's sort of 3-to-1 leverage, for example. But what happens here, margin is very dangerous because if we take a look at this, we can see that the margin calls is what also affected this individual that was down 22,000 in this video. The margin calls kept coming in. So this individual is working a day job just to pay down the margin, just to keep up with the losses. They're not making any money. They're pouring money into this. It's gotten to the point where they're continually pouring money just to get out of these margin calls. And you can lose, as you can see here, couple issues with margin. You can lose more funds than you deposit in your margin account. The firm can force the sale of securities and other assets in your account. They can sell your brokerage without even contacting you. They will give you a 3-day notice as this individual gets calls or emails every so often few days to say, hey, margin call, come on, either sell something or top up your account to kind of get back to that maintenance level. Otherwise, we're going to start liquidating. And the problem here is they will liquidate whatever they feel like. You can't pick and choose, sell my Tesla, but don't touch my Apple, or sell this without this. No. The broker wants its money back, And if you're getting into a situation where the losses are accumulating too much, they will start selling your stuff to get you back to these maintenance levels where then you're still in margin and you still have to fight back out because now you're in a down market. It's really hard to get back out. So hope you got some value out of today's video. I just wanted to throw that out there. I really appreciate to whomever was able to share the information of a deep dive into their account to let us kind of behind the scenes. And these are things that you may have experienced or may experience as a new trader, as a new investor. Investing is wonderful. It's one of the greatest ways to grow your wealth, to grow your money without you having to physically do anything. Getting your money to work for you. It's absolutely invaluable. But at the same time, you have to do it the right way. You have to do your research. You have to know what you're buying. You have to be safe, especially if you're a new trader. Avoid margin. Get to know what you're buying and selling. Get to know these companies. Get to know their fundamentals. And then from there, you can start maybe experimenting later. But at the beginning, number one rule, do not lose money. You have to. You will not be able to recover from losing positions or an account that's being drawn down if you start running out of cash. Your job in the market, okay, your job as an investor is to place the right trades, meaning get out when you need to get out on the profit side, but also cut your losses quickly. Okay? That's your job. The market's job, okay? When I had this epiphany moment, I'm like, I've been doing this all wrong. You need to do what you need to do. You cannot make money in the market. You can't. Once you place that buy order, you can't do a dance or sing a song that's going to make the market go up. Your job is done. Place the orders where they need to be. Your stop losses below, your sell orders to get out on top. And the market's job is to make the money. But if you don't place the orders, then the market can't do its job. So I'll leave you with that. Stay tuned for more updates. I'm going to be throwing some more crypto and stock market update videos, live streams for you this week. So make sure you set some reminders for that. And make sure if you're brand new to the channel, I really appreciate you subscribing for more pure value. And I'll catch you in the next video. Thanks so much.